Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of the video is what is real estate professional tax and how um, you can eliminate your income tax using the real estate professional status. So if we talk about rental, real estate is ordinarily treated as a passive activity under the Internal Revenue Code IRC 469, which limits our taxpayers' ability to offer passive losses against active income. However, the investors who qualify as real estate professionals can enjoy a significant tax advantage. They can treat their rental losses as an non-passive and fully deduct them against the other active incomes. They can translate into thousands or even tens of the thousands of dollars in annual tax savings for those with the substantial holdings and a backlog of passive losses. So, what are the key takeaways in this topic? Real estate professional tax benefits, including full utilization of the rental losses against ordinary income. You must meet strict real estate professional requirements, 750 plus hours, more than 50% test, and maintain meticulous records. So both individuals and the corporate entities can qualify. Structuring matters. This guide dives deep into, first of all, what constitute real estate professional status under IRC. Then comes the dual test requirement and the grouping elections. The third is how sole proprietors, partnerships, and the S corporations can each leverage this status. Then best practices for the contemporaneous record keeping to withstand IRS scrutiny. And then concrete real estate professional tax benefits and the strategies to maximize them, common pitfalls and audit triggers, and a real world case study, a robust FAQ section answering investors' questions. So, whether you own a handful of a single family rentals or manage a diverse real estate portfolio, understanding and applying these rules can unlock significant taxes. So what the table of content create contains. So under first of all, it contains understanding the real estate professional status, difference between passive versus active treatments, why it matters, and then enhanced tax planning and the year end tactics. So then comes the real estate professional requirements. First of all, 750 plus hours material participation test, then more than 50% personal service test, then comes the grouping elections. So, qualifying individuals versus through a company, a sole proprietorship versus single member LLC. The B part is partnership. The C is S corporation. Then deep dive entity structure comparison for the RE professionals. Then comes the essential record keeping for the real estate professionals, core documentation, best practices, advanced record keeping strategies for the real estate professionals, then tiered documentation system, audit ready binders, then tools and templates. Then comes the real estate professional tax benefits. First one is full deduction of the rental losses, then comes the eliminating suspended passive losses, self employment tax planning, state tax advantages, pairing with other strategies, then strategies to maximize lucrative benefits. Can real estate professionals use Delaware statutory trust to defer taxes? What is a Delaware statutory trust? Are DSTs passive or non-passive for the REP purposes? When DSTs make sense for the real estate professionals, what you are looking for to exit active management. Second, you have other passive losses to offset. Then you are planning to estate or legacy transfers, what REP rules still apply after moving into the DST? So should real estate professional uses DSTs? common pitfalls and the IRS audit triggers, audit red flags, how to avoid mistakes, then case study from casual landlords to real estate professionals, then conclusions and the next steps. So, understanding the real estate professional status under the IRC 469, a taxpayer can elect or treat rental real estate activity as non-passive, but only if they qualify as a real estate professional. This election allows full deduction and the rental losses against active income, wages, business profits, elimination of the suspended passive losses that otherwise carry forward indefinitely. So then comes the greater flexibility in the year and tax planning, including time of the expenses and the income. Then comes passive versus active treatment. Passive, what are the passive activities? By default, rental estate is passive. Losses are limited to passive income, excess losses are suspended. Then, what is the active activities? Non-passive activities. So real estate professionals treat rental as non-passive losses immediately offset active income subject to no net loss limitations. A real estate professionals is one who materially participates in real property trades or the businesses. So why it matters? Investors, the first point in this discussion is that investors with significant passive losses due to depreciation improvements or the startup expenses often accumulate suspended losses over time. Converting passive rental activity to an active status can wipe out those losses, reducing taxable income dollar for dollar. So what are the enhanced tax plannings and the year end tactics? The first one is the expense acceleration. So prepay insurance premiums, management fees and the maintenance contracts in December. Move discretionary capital improvements into the year, and then comes income deferral, delay rent increases or lease renewal until the January. If you are nearing your hours or thresholds, shift billable property management task into a January by creating year and work orders. Then the number 3 is grouping election reviews, confirming your 469 election is attached to your timely filed return. If the property mix changes materially, so consult your CPA to determine whether to request IRS consent to revoke or amend. So the fourth point in the discussion is interplay with 1031 exchanges. When swapping properties via 1031 exchange, identify replacement property task as qualifying real estate services, track acquisition related hours in both years to maintain professional status. Then comes integration with the broader tax services. Bundle this strategy with annual corporate filing and our tax preparation services for streamlined compliance. Plan a mid-year check-in, reaffirm your 50% test as other business activities ramp up. So real estate professionals requirements to qualify, a taxpayer must satisfy both the 750 our material participation test and then to the more than 50% personal services each tax year. So the first point is 750 hours material participation test. So what are the requirements? Perform at least 750 hours of the services in real property trades or the businesses. Then qualifying activities include: the first is development, construction or the reconstruction; the second is acquisition or conversion of the real property; the third is rental management, tenant selection or the rent collection; the fourth is maintenance, repairs and the improvements; the fifth is daily operations and the oversights. Then comes aggregation. Hours can be combined across all the real estate activities, not limited to individual properties, must account for every activity separately in your lax. So, the second is more than 50% personal service taxes. What are the requirements in this case? Real estate services must constitute more than 50% of taxpayers' total personal services hours in all trades and the businesses during the year. Then calculating total hours include hours spent on W2 employment, self-employment, consulting, and other businesses. So exclude passive activities unrelated to the real estate. Then comes key points. So if we talk about key points, it contains even if you exceed 750 hours, failing the more than 50% test and disqualifies you. Annual recalculation is required. There is no multi-year carryover. So grouping elections are taxpayers may elect to treat all interest in the rental real estate as one activity. The timing make the elections on a timely filed original return including extensions. Then advantages simplifies meeting the 750 hours test by aggregating hours across all the properties. Then reduce record keeping complexity when activities are similar. Then comes the point of considerations. Once made, the election remains in effect for all the future years unless consent to revoke is obtained from the IRS. Mixed use properties or diverse business activities may complicate grouping. Then comes qualifying individually versus through a company. Now, your choice of the entity can influence how you track participation and allocate hours. As a sole proprietor and the single member LLC, what are the pros and cons in this case? So simple reporting on the schedule E, and the second pro in this case is direct attribution of all hours to you, facilitating the 750 hours test. Then what are the cons in this case? No liability protection beyond single member LLC shield. Then passive activity rules apply just the same, no K1 to the shift hours. So what are the B partnership? What are the pros and cons in this case? Hours can be allocated among partners via the partnership agreements. Losses flow through on schedule K1 potentials for the strategic allocations. Then comes cons. Must ensure partners lodged hours match partnership allocations. Dispute can arise if one partner logs significantly more time than the allocated. Then comes S corporation. What are the pros and cons of the S corporation? Reasonable salaries for active participants, extra income as distributions. Then hours tracked by the officers and the employees can support material participations. Then what are the cons of the S corporation? So if we talk about the cons, it has must distinguish between wages subject to payroll taxes and distributions. Entity level cost such as filing and payroll may outweigh the benefits for small portfolios. So the irrespective of the entity, maintain a clear partnership or operating agreement that outlines hypothetical hours allocation, then responsibilities per partner officer, then producers for amending hours if the business focus changes. So what to deep dive entity structure comparisons for the RE professionals. So for the entity types, sole proprietor and the single member LLC, the pro is that simplest reporting all hours count towards you. The cons is unlimited liability, no hour shifting via K1. So the what are the special considerations for the sole proprietors or the single member LLCs? Must file schedule C or E and losses flow directly to the 1040. Then for the partnership, pros are flexible hours allocations in partnership agreements, K1 allocation of losses. The cons are potential partner disputes and more complex bookkeeping. Then comes draft clear agreements, reconcile partner reported hours quarterly. Then S corporation office hours and the wages crystal clear potential. SE tax planning, payroll cost, two tier tax rates, allocate salary versus distribution, and the maintain minute by minute logs. So, where I will talk about key takeaways for portfolios with five or fewer properties. A single member LLC often suffices, and for the large portfolios which have 10 plus units or the multi-investor deals, benefits from the partnership or S corp, provided you formalize hours allocation and hold mid-year reviews. So what is essential record keeping for the real estate professionals? The IRS scrutinizes real estate professional claims closely. Absent reliable records or estimates are unlikely to stand up in an audit. So, what is the first essential record keeping is core documentation. So, for this, contemporaneous logs, digital time tracking apps, and the spreadsheet templates record dates, property identify and the tax description and the hours. Then comes calendar entries, Outlook and the Google Calendar snapshots showing meetings, site visits, and the tasks, screenshots or the exported ICS files. Then comes the supporting files, invoices, project proposals, work orders, and the checklist. Email showing coordination with vendors, tenants, and the contractors. What are the best practices? Daily or weekly entry, update logs in real time or at least weekly. Then backup and archival, store logs in cloud storage with version history, and then periodic review, reconcile logged hours against the calendar events monthly. Then IRA audit folder, prepare a separate audit binder with the indexes. Then what are the advanced record keeping strategies for real estate professionals? So if at the first, tiered documentation system, real time logs. What use our dedicated time tracking app, Clockify configured with projects for each property, how record start stop time for every task, then leasing, maintenance, site visits, and why contemporaneous entries carry the most weight in the audit. So then comes the calendar correlation. What to do it? Export monthly calendars showing all real estate appointments. So how tag events with re property name or the address in the title. Then why cross checks hours in the logs and demonstrates consistency. The third is sporting artifacts, for example invoices and the receipts for the vendor work, signed tenants, and the communications. And so work orders, photographs of completed improvements. Then comes the storage, centralized in a cloud folder, Dropbox, or OneDrive with subfolders organized by the year, property, and the month. Then comes audit ready binder, digital or the physical. The first one is cover sheet, index of all documents organized by this section. Section A, time tracking exports sorted by the quarter. Then section B, calendar snapshots with highlighted entries. Then section C, tax specific proof, photos, signed contracts. Then section D, which has election documentation, copy of the original grouping elections. The third point is tools and templates. The first point is spreadsheet template column for the date, property, task category, description, start, stops, total hours. Then comes the mobile app options, which is Clockify with offline mode, timely automated time captures, a custom Airtable base for the multi-user lodging. So that then a backup plan, weekly automated exports, emailed or to your accountant or stored in a secondary cloud account. Then real estate professional tax benefits, meeting real estate professional status unlocks several powerful benefits. The full deduction of the rental losses, passive losses rules no longer apply. Rental losses are now offset against other income on the form 1040. For example, depreciation and the expenses generate $50,000 in rental losses. Then, as a real estate professional, you can deduct the full of $50,000 against wages or the business income. Then comes eliminating suspended passive losses. Carried forward losses from prior years suddenly become deductible in full. So no need to wait for the passive income to absorb them. So third is self-employment tax planning. Rental income remains exempt from self-employment taxes, but active treatment allows more favorable income characterization elsewhere. Redirect management fees to related service companies that may pay self-employment taxes optimally. Then comes the state tax advantage. So that was all about the discussion. So do subscribe the channel for more helpful videos. Thank you.